Good afternoon. This is the first time I think we are meeting because all these previous 9 sessions are done online, and generally we have this postgraduate in person. So I think because of the online, I was managed to complete the syllabus in 9 sessions. Generally, it will take because I never had interaction. It was very boring for me because I didn't hear any voices. I was just speaking. So this time round, I think at least you are here. I have already given you the individual assignment. I hope that you have had a look at it, read it, but I'm not going to do it now. What I thought was devote the first session of today's class for kind of revision. I will go through most important slides which I have shown in my previous sessions and explain to you the importance of those. And then we move on the second session to discuss the individual assignment. The next 2 sessions, if you are here or not, I will touch on the past papers. Then probably then you will be ready for the exam. If you do, not sure. So otherwise, you want me to do the current question paper and then discuss it. That will be a better proposition, I believe, but institutes won't allow me to do that because they will keep that question paper very confidential until the day of the exam. So, to start with, I have put them on the slides. The subject of risk management is should have originated somewhere in 2007 because in 2007 world we had a financial crisis, especially in USA. Nowadays, all these provincial banks became bankrupt. They call it subprime crisis or financial crisis, whatever. What happened was, I used to say like this: banks become very greedy. You all work for bank, but our motive is to make more money. The motive of profit making will sometimes create risk. That's why we say, higher the risk you take, higher the profit you make. However, if you are not manage your risk, higher the losses you are going to make. In 2007, what happened was that. So banks in USA are generally not like our culture. People work, whatever they earn that money, they will spend and give very lavishly. The government found this was a big problem because none of them want to make houses, make savings, because even if you save, they don't pay you interest. Interest rate on savings account is 0.25%. So is it worthwhile saving or better to spend and enjoy? So that culture didn't make good sense for it, in economic sense for the government. They want people to prosper with asset base. Now in Sri Lanka, it's our dream to work. You want to have your own house, you want to have your own car. There, of course, they can buy a car. It's not that expensive, it's a consumer item. But a house, you need to take a mortgage. A lot of people are reluctant to take a mortgage, other than they want rent. So that's an eternal commitment until a long period, which they don't want to commit. So the government encourage people to own houses by reducing the interest rate from the housing market. on one hand. Then once the interest rate is reduced, financial institution doesn't want to lend. So they gave a rebate to the financial institution saying, if you create a housing loan, government will give you another 1% more, other than the interest that you receive from the bank. So this creates kind of an incentive for banks to lend on housing. But in USA, every citizen has a credit rating. So if you are a citizen of USA, all your receipts from your salary or any other income will be recorded in the centralized computer. All the bills what you pay also get recorded in this same central computer, unless otherwise you work some part time and receive cash. And it is not allowed by law to pay any employee cash. Instead, all has to be paid to a bank account. Once it goes to a bank account, the centralized computer, based on your identity, will create your income expenditure statement. And based on that, they give you a credit rating. And you walk into a bank and you give your ID, they will run that ID and find out what is your credit rating. You know what is credit rating? Credit rating is your credit worthiness. It can be a triple A, double A, single A, triple B, double B, B, or C. Those 7 categories will give you a credit worthiness. Any customer who is on triple A, double A are called prime customers. That means their credit worthiness is very high. And banks would like to lend to such customers. We call it risk-free investment for bank to lend any money to prime customers. So when you are greedy, what happens is all the guys who are on the prime level has already taken housing loans. Who is left are B and minus. And those guys, when they walk in, generally banks refuse. But you know, bank has got a rebate from the government, 1%, and they got very greedy to earn that, and they started lending to subprime clients, whose rating were not double, triple A, double A, triple B, double B. Even sometimes they went to the level of C. C is in USA is considered as a non-investment category. That means banks should not touch those clients. They started giving it, thinking that the property prices will hold. Property prices will increase all the time. In Sri Lanka, generally property prices increases year on year. USA it's not like that. Sometimes it gets stagnant. So in 2007, these banks which gave housing loans, they get a portfolio of housing loans in the loans and advances portfolio. But to lend more, they need money. What do they do is, they take that housing loan files, they can go to an investment bank, keep those files as collateral or security, and ask for more money. So they did that. Instead of financing those from your own deposits, banks also borrowed more money from other banks called investment banks and created money supply for them in order to lend for housing. Then they started giving this money what they have got from investment banks given to subprime clients in order to earn that 1% rebate. What happened is, there was a time, winter came, world market oil prices went very high. And during winter, you know, they need to get heat. All the houses need to be heated. They use a lot of oil, they call it gas, and you need to pay for those electricity, gas, and also when the oil prices go up, not like here, Then the next day your petrol prices are up in the petrol shed. So bus fare will go up. The entire cost of living will go up. So this happened in USA. People need to live first in order to pay money to the bank. And they defaulted all their housing loans. Once you default housing loan, what happened? Not like in Sri Lanka, they don't go to courts. If your installments, 3 installments are overdue, they go to the registrar of the court and say, we have an agreement with this client to pay, money has not come in, and they get the registrar to sign, certifying that the installments have not been paid. That is enough for you to bank and give it to a real estate agent. This particular house number, that will go and put a board in front of your house, available for sale. Now, when this happened in USA, there were some streets, entire houses on that street were for sale. Then what happened? Prices of those properties came down. They came down below the loan outstanding. And they had to sell whatever the price and the recover that loan outstanding. So banks suffered losses. Investment banks called on the banks to pay. They couldn't pay. Over the bank, unable to meet creditors, what will happen is the lender will go to again courts, file a petition, and seal your bank in quoting this. So there was a day they said about 145 provincial banks declared bankrupt. One single day. That was the financial crisis. Unfortunately, we are very lucky in Sri Lanka. We don't have such strict regulations. And also, most of our banks are managed properly by the regulated Central Bank of Sri Lanka. They don't allow you to, borrow more money by giving you an asset base to another investment bank. There are limitations. So, with these restrictions, they attach real importance for risk management. Risk management, I put these slides, you can see, actually depicts like this. The ship on the harbor is very safe. Like you are giving loans against the 60%. And that's not the banks are meant to. Banks should take risk and put this ship onto the sea. Immediately you start evaluating your customers better and give clean loans. That's what the banks are meant for. That's why all these credit rating things are in place now. So if you give against your fixed deposit, what will happen is what you get is maximum 3%. And that 3% is not sufficient to manage a bank. Because you need to pay staff salaries, you need to maintain buildings. That is not enough. You need a higher spread from your borrowing or deposits and your lending. So you need to take risk. So to take risk, you need to manage it. And what we are learning today is how do you manage it. So risk is I gave a definition that day. It's an uncertainty. We are not sure that you are going to make money because something will happen, and as a result, we have a loss situation. Risk is actually sometimes positive or negative. If you take positive, you take higher risk, and if you make a positive result, you have higher profits. But what we talk about in business cannot conduct without taking risk. I'm going fast because I'm doing a revision. So, rest of things I believe are not so important. So, we had a definition. Then you need to understand what type of risk prevail in day-to-day business of the bank. Banks are financial services industry. Sri Lanka, we have 26 banks, some 52 finance companies and leasing companies. If you compare to rest of the world, ours is a very small economy. And we have number of players high. In UK, there's only 4 banks. Singapore, they have 3 banks. Sri Lanka, we have 26 banks. We say they are competing for a small piece of cake. But our economies are even not bigger as those countries. And on top of that, now we have a lot of competition coming from various finance companies, leasing companies, and even telecom companies are now trying to do banking. Easy Cash is a banking product. So there's huge competition in financial services. As a result, also the risk has increased. So first, our major risk type is financial risk. Something to do with money. So we are dealing with money, our raw material is money. What does the bank do? We call it in technical term, we say we take money from economic agents who has surplus. And those who are not willing to take risk. Then we give it to economic agents who are willing to take risk but don't have money. And in between we keep a margin. So I want to ask a question. You all are bankers. Is banking is a profession or a business? Business. Anyone who thinks banking is a profession? Banking is a business. We are no better than the money lender. So we take from people who have money and we lend to people who don't have money. We keep our cut. That's what we do. During doing that, we make risk. So our major risk is financial risk. Financial risk can be categorized into 3 other areas. Major risk is the credit. And I need to go to the board also and draw up a balance sheet of a bank. I think probably if you have followed I draw this current assets plus fixed assets equals current liabilities plus long-term liabilities plus equity. Normal balance sheet. But in a bank balance sheet, some of these items are different. If you take a company, major current assets are his debtors and stocks. We don't like to keep our stock. The stock is money. The more you keep money in your tills, you're not going to make any profits. So, in a bank, the current assets, if we say this is 100 million total asset base and current liabilities, I would say we have cash, we have investments, and we have loans and advances. I would say this will be 90 and this will be 10. How would you like to divide this 90 between cash, investments and loans and advances? Central bank has different rules and directions to the bank. They say you need to keep as a liquidity asset ratio and a reserve ratio. Reserve ratio is to keep cash in your tills, in your ATM machines, and in the central bank current account. none of this cash will earn any money for you. They say to make your obligations right, that is to pay your depositors when matures and various transactions you want to do. They say you need to have at least 7% in all those things which I mentioned. So it will be, to take 100, you need to keep 7 billion in cash. They also say you need to have 21% liquid asset ratio. So liquid assets will make loans and advances doesn't make you liquid assets. Simply because the money is with the customers, you are not sure until it is being repaid. Whereas your investments like treasury bills, bonds, and various other things you can put into the market and make money by selling them. So 21% to make that, you need at least investment of 14. So if you 14, 21, if you deduct from 90, it will be 69. Now you can see financial risk. 69% of, or 69 billion out of 100 billion in your asset base are not with you. You are giving it to customers. And how you are given? You are given credit. So credit risk is the highest risk if you think in terms of your balance sheet, is your major risk. And it is a financial risk. The category part of financial risk is credit risk. Then we also have something called market risk. Market risk coming from your investments. Anything that you buy, in order to sell that, and if you cannot sell more than the price what you have paid, you make a loss. That is market risk. Banks will have investments by way of special bills, bonds, company shares. Nowadays, banks buy gold also, a commodity. You need to do import-export transactions, so you need to have foreign currency reserve. Those prices also fluctuate. So any fluctuation of the value of your investment on a negative terms will create a loss for you. Banks will have foreign exchange loss, bank will have equity loss. All those are all market risk. So another major item in your balance sheet, because you create positions of those in your balance sheet, and those positions will lose value when compared to the market and compared to your investment early. And that is called market risk. Then on the other financial risk type is called liquidity risk. What is liquidity? Why central bank is insisting you to keep 7% in cash if you are not getting any money, if you are not getting any return? That is to meet your obligations. Your depositors, they come and request withdrawals. You have made a commitment to grant a loan. And on that day, if you don't have cash disbursed, you have a liquidity problem. So liquidity is more dangerous because when you don't have money to pay to somebody, I don't know in Sri Lanka, but in America, I told you 14 days is the time you have. Somebody can file action and then your close are closed. So Sri Lanka also, central bank thinks liquidity is a major crisis. Have you heard the thing called run on a bank? What do you mean by run on a bank? when you have liquidity problems, next step will occur is run on a bank. So I'll put it in another story. Which department you were? Credit. Good. I made a deposit with is in operations. And she has accepted the deposit of 100,000 of money. And I got a piece of paper. That piece of paper is a certificate which says accepted the 100,000 deposit. Maturity date, they are given 1 year ahead. That's the duration which I requested, which I thought I will need money until that date. And value given, interest rate is given. The two officers have signed and given me this. My money is in the bank. After 3 months, I may require this money. So I go to the bank and say, look, originally I thought I will need this money for 1 year. Now the emergency has cropped up and I need the money now. The certificate which I got is a valid legal document. And that valid legal document says I cannot withdraw money until the maturity date. But I go to the bank and I ask for money. Will you give me? You are in the credit department, what do you do? You will ask me to take a cashback loan. I want money, you ask me to borrow it. And you charge 3% more than what I'm getting from the bank. I say, I don't like that. I need my money. I don't want the interest. Now, will you give me that? Because when a bank accepts a deposit for 1 year, you have your finance department. That finance department and other places, they have a committee called assets and liability. And if they accept the deposit of 1 year duration, they will make sure that money will be used for an asset, that's a liability to be paid to the customer. That means at least they will invest that money to a loan which are repayable in 1 year. Now what will happen? I am asking after 3 months. I am going to upset the whole position, but your assets and liability management has taken. You have the right to tell me, no, you cannot withdraw for legal terms, but no bank in Sri Lanka will do that. Very simple reason, it's the reputation. Because the moment you say no to me to pay, I'm not going to tell that I had a deposit, I went to withdraw it and you didn't give me. I will say this bank doesn't have money. When I say that, all the other depositors will come and withdraw money. That is called run on a bank. In Sri Lanka, we have those situations, quite a few. Banks which are now established had run on the banks, but they have survived. If run on the banks take place means they will try to withdraw all the deposits, which have your assets and liability management has already given loans for a longer duration. You cannot go and ask those guys, please give me the money now because depositors are asking. You can't do that. So then you will have a situation. That situation called is a liquidity crisis. The liquidity crisis can create a close of a bank, and therefore it's another important risk category or risk type you need to manage. So you need to manage credit, market, and liquidity. Those three are called financial risk. Then If you don't give me that deposit, you will have reputational risk. Banks run on reputation. And the moment they lose reputation, your depositors are not going to raise money. Tell me why banks run on deposit. Now I am going to the liability side. If I am going to put, this is the depositors, customer deposits. Long-term loans, what you get is we can call it debentures. This is your capital. Shareholders' money plus any reserves. So those days you need to keep 10% capital minimum. So I put 10 here. Long-term liabilities, debentures, I'll put 5. So customers has placed in your balance sheet about 85 million, and you have lent 69 of that. You are keeping 7 in cash. The other balances you have invested in fixed assets and also investments. Now, this is our balance sheet look like in a bank. We move on to reputation is that you fail to pay me. Then we move on to the other area of risk. Now, I'll go into another. Have you heard a thing called debt equity ratio? Probably you have heard. You have done ratio analysis in your other class. You won't tell me, but I know you have done it. So, debt equity ratio is, we'll say, what is debt? This is equity. This is short-term debt. This is long-term debt. So we'll take this debt together is 90, equity is 10. That's what the ratio is. Your bank's debt equity ratio is 10. Now I go back to another story. This time I don't have a deposit, but I have a project. I come, you are in the credit department, so I am again coming to you. You made a mistake by telling me. Because generally credit guys will never tell that I am in the credit department. A lot of questions will be asked from them. My project will say 100 million. And I give my entire proposal. You have gone through, you have done my evaluation right, I have financial evaluation, you have qualitative evaluation, you have done all this internal rate of return, all that you have done, credit guy generally do. And you think my project is very viable. And I'm going to make break even in 5 years and all that you have done. And credit worthy customer, and therefore you will give me the money. The other question you will ask me is, what is your contribution? Then I will come and say, my total project is 100 million, I am putting 25 million to the project. So, what is the debt I am asking? I am asking 75 from you. I am putting 25. Now you ask the rest of the thing, can I approve this loan? Will your head office will approve this loan? Debt equity is 3:1. 25 to 25 is 3 times into 1. Very good ratio when you consider debt equity ratio. That's what bank expect. Bank expect customer to contribute something so that he will not leave the project. He is going to lose 25%. So now I am going back to the top again. Bank 90 to 10. 9:1. Now, who are the lenders to bank? Those depositors and debenture holders. When you have that high debt equity ratio, why those guys are keeping money in the bank? If you go to a accountant, taking these two ratios, he will say most riskiest place to keep money is the bank. Because the ratio is so high. That bank don't mind losing 10. 90 is given by somebody else. Still people come and put money, right? That is your reputation. Not only reputation, I am going to go into another type called here, this yellow line, yellow area called regulate. Banks are highly regulated industry. That means there is a godfather above you. Godfather is the Bank of Sri Lanka. They won't allow you to play the way you like it. They have directions, they have given how do you conduct your business is generally managed by Central Bank of Sri Lanka. They have a department called Bank Supervision Department. They will always see that you take very calculated risk into business as a, if not, customers' money are in danger. So when you have this, if you don't comply to Central Bank of Sri Lanka, you have another risk called regulatory risk called the compliance risk. So our next type is compliance risk. Then banks now need to operate to do business. During the time I joined the bank, actually, there's one place you can go to do business, it is a branch or a building. Now you don't have to do that. Now you have different channels of doing business. You can go to ATM and do a transaction. You can go online and do internet transaction. You can use phone banking to do a transaction. Now channels are very wide. Our time we call it banking business is brick and mortar operation. What do you understand by that? Brick is the stones that you build to get a house. Mortar is the cement. So brick and mortar put together, you get a building. So you need to go to a building to do a transaction. That is a branch. No other place you can go, and branches are at that time open only from 9 to 1 o'clock. So you have only 4 hours to do banking business. And they entertain very few people also. Because of competition and demand from the clientele, now actually we have very wide range of distribution channels. When you have wide range of distribution channels, those days operation risk is called failure of people, systems, and events will cause you operational risk. So, what is the failure of people? People is employees. If you do a mistake, and as a result of that mistake, if bank suffers a loss, that is called operational loss. Systems. Those days we only had ledgers that was handwritten. Thereafter, some time you got a machine, put the ledger card and print it. Then you get a computer. Now you have computer. Computer make a problem and create a loss for you. It's a system. Events can be internal and external. Your assets getting damaged by lightning, fire, or whatever. It's an event. If outside robber come and rob you, the external event. And any losses suffered from these events are called operational risk. So the next big item in the risk type is operational risk. Now we have tackled credit market liquidity. regulation, reputation. Now we also talk about operations. Operations now involve information risk, that is technological risk, because we use computer. The other type is called strategic risk. Now, strategic risk also is very important. Strategy is called long-term plan. All the banks have this strategic plan for next 5 years. They create budget and say that next year, today's our asset base is 100 billion, next year we want to make it 120 billion. So they increase your loans and advances from 69 to 75 like that to create a budget and tell your staff, give additional targets, you need to give more loans, you need to get more deposits, and you need to make more money in order to achieve that. That's a strategic plan. When you have so many players, the strategic plans are very vital because competition can kill you. All the banks have, in your corporate divisions, they have created something called, we'll say, this is for deposits. Okay, this is Bank of Ceylon, they will have this much. Commercial bank this much, Sampath this much. Like that, they will see entire economy, how much deposits each bank has got. And they compare every year on year, and see whether we have increased our deposit base compared to rest of the banks, or we have reduced. And if you have reduced, that means you are strategically failed in one aspect. So strategic risk was very important. To be in competitive business, you need a strategy. And to do that, you need to have a good customer base, so you need to satisfy your customers. And so now banks spend a lot of money to be strategically important bank. If someone working in the marketing department, I don't have to ask, your budgets are very high. Banks do advertising, they think they are also selling sunlight. So they also try to brand their product. That's why all these minor savings account have these names, Arunadu, Tikiri and all that. Because that's a kind of strategy. If you want to get more of business, you need to beat your competitor. So that's how you create. So the next item on our risk type is strategy. So 4 major risk types. One is financial, operational, regulatory, and strategy. So if you know this, I think you can answer one question. That's why I spend a little time on the risk types. Now we need to know, we know what is risk, no risk types. Now we are into risk management. Risk management is a process. Like any other management. Management is planning, organizing, and using your input, creating a large output. As a result, you make profit. That's what is managing is about. Risk management also similar process. Our process start with, I'll erase this part of it. process has steps. First, you need to identify the risk. To know the types, easy for you to identify. That's what I went on types. Then once you identify, you need to measure. They say anything what you can't measure, you cannot manage. That's a management field. You should know how much. Similarly, if you identify the risk, you know how much in value in terms of rupees is risk. So you need to measure. Third one is, then based on that amount what you are going to lose, you take a decision. That is what you call response. Like the person coming, now I came to him with the proposition of asking 75 million rupees for my proposal. Now he asked me how much you are going to contribute. I said 25. And so he measured that he's not going to lose any money by giving this. So he thought this is a better proposition, and the response is to accept that risk. The risk is that in case if I fail, then I am going to lose my 25% first. And the assets will be there for him to sell and get 75%. So he has taken a very calculated risk. And therefore he responds saying, approve my loan. That's what you call acceptance. If you think I'm going to lose more than 25% if I fail, and part of his money also will go, the bank's money will go, he thinks it's not a good proposition. Then he will avoid that. That's where credit proposals come. Sometimes your credit staff will decline. You like to accept or decline most. Generally, bankers like to decline most because otherwise thereafter it will be a headache. But if you decline, you lose business. Because giving me money will give you interest. So we will see we calculate and see how much you are going to make money. Even he thinks that I may lose this business or this project won't be viable after some time. He may think during that time he has earned his all money, he still will lend. So that kind of acceptance will be there. So what he does is, if you accept that, you can't just keep like that. You need to monitor. Give me a loan, and if I don't pay the first installment, if you keep quiet, I'm going to definitely not pay the second installment. During that time, you have to send me 100 letters, send me a recovery staff to my home. All that you need to do, that's what we call monitoring. And then still, if you can't get, you need to control. You will put saying no future credit. My all checks will be bounced. All that will happen because of the controls. All these activities you need to report to your higher officers. That is what you call reporting. And this is risk management. Very simple. You identify, measure, respond, and accept to avoid, and then monitor, control, and report. What else to do? And you have some banks have about 25 people managing risk. It's a back office, and people who are in the front office think these guys are idle. But they have an important role to do. When we go through, you will identify. It's not easy. It's not easy as you put on the board. So that's our first session. Probably I have taken 45 minutes and I need to go faster. Now, after 2007, I told you financial crisis took place. Our central bank also got a little bit jittery because if the world can fail, Sri Lanka can fail easily. So, central bank until that day, never had great emphasis on risk management in banks. They allow the business people to manage the risk also. 2007, they got little jittery and found that time already internationally there's pressure. Because in 98 also they had a crisis like this. And International Bank for Settlement, which is the World Bank, created a committee called Basel. You have heard of it. Basel is actually a town in Switzerland. This is where this particular committee met. And they created Basel I. They thought major risk of a bank is credit. And they brought up the Basel I. Basel I is very simply they risk weight all the credit proposed credit facilities what you have given, arrive at the total, and they say you need to have 10% of that total as your capital. That is the only requirement. 2007, they thought banks should not only fail because of credit risk. They thought the other two financial risks, market risk, operation risk, also can create losses to the bank. So they said, you make other assumptions and arrive at the risk weight of market risk and operation risk and put all three together. And if you have capital base of 10%, you are complied with the Basel II capital adequacy ratio. That's what that came in 2004, but in Sri Lanka, we went to operation in 2007. Since that day, central bank was not still satisfied because world has failed. We need to safeguard our banking system. So they invited a lot of bankers and had a lot of discussions. They wanted to create something called a direction to bank. And that direction came in, actually discussions went on for 4 years. Direction came in 2011. And direction number 7, which I given to you, I think you may have seen it. That direction was the regulator formally identifying the risk management in banks. I got a new job. Because they say when you have that direction, you need to have a chief risk officer in the bank. And that should be a very senior position. And that which they were looking for a person. I was in corporate credit and they put me in that. From that day only I started learning risk credit. From 2011 I didn't know anything about risk management. Because of that direction came, then I had to read and read. I didn't understand a single word of it initially. But later it was very interesting subject, became a very interesting subject and lot of scope for progress. And you can get, because you are reporting to the board of directors and they will give you increments and various other things, promotion very quickly as possible thereafter. So I think this particular position thereafter risk people would like to go to risk management. They call it, those days we say, the credit department is the department. And by an operation, you always try to go to the credit department. Because it will give you more promotions quicker than other departments. But after 2011, risk management was the department. And a lot of people got promoted because it's a new subject, few people know about it. Then that time, central bank came up with this direction, they call it integrated risk management framework. Integrated means they want to see we manage all the risk types what we have already spoken and to have, we call it a helicopter view of looking at risk. That means you look at all the risks. Once helicopter view I mean here is board of directors became responsible for risk. Because if something goes in the risk, central bank can call the board of directors saying your bank is not managing. The board of directors got interested and there was a board subcommittee called BIRNC, Board Integrated Risk Management Committee. And chief risk officer will report to them. You can surpass your CEO and the general manager, and you can tell bank is having problems in risk direct to the board. Yeah, Rajendra, good afternoon. I'm at a lecture. Can I call you later? Okay. So this particular instructions or the direction came from Central Bank in 2011 for integrated risk management framework. What they want is it's a management process affected by the board of directors and rest of the staff. So what I'm going to go again is this slide. Now I presented all this online. Have you all managed to print this? Don't tell me to print it. You can ask the institute to print all my 12 sessions and give it to you. Maybe you go for the exam. Now, integrated risk management has three important areas called policy, structure, and procedure. What the central bank wants to guide the banks is to create policies, how they manage different type of risk that we have discussed. Then they want to create a structure. How do you manage? Structure means your organizational structure. How do you place your people in the structure who will manage the risk in the bank? The other one is procedure. Procedure also what you do is you create manuals and give it to various departments. So risk management becomes responsible for all these three areas. So first, one ideal structure for the bank is called 3 lines of defense. We will have board of directors on top. On your left side, what you have is your business sector, which is headed by your general manager or the CEO. You will have people who are at the bottom are your counter staff, then your junior executives and various people who are performing business. We call them risk owners. 3 lines of defense is like army. You put all those broilers in front. Those who have 3 months or 4 months training, they are given a gun and they put it to the battlefront first. All the top brass are from behind, they are directing them. It's like that. So, any losses happen is those are in the front. And in bank for the same, most of the work is done by juniors. Seniors have passed that stage, so they don't have to work. They can direct you from behind and win the battle. So, it is 3 lines of defense. First line, also right at the bottom, are the juniors who doesn't have much experience, but they do the work. So they can make mistakes, that's why we have operational loss. Then people who are in credit can give wrong credit, then we have credit risk. Guys who are in the treasury, if they are new, they will do wrong dealings, they have wrong investments, and we can make loss. So risk is going to prevail for a long time because this is the approved structure in all the banks. Banks are, we call it hierarchical agents. That means we ask this question from juniors who, when they come to join the bank. I have been in this interview board, they are, I put this very unusual question, or it's a usual question. What do you like to be in 10 years? Everyone says, I want to become the general. I don't discourage myself. Good thought. I think for myself, it's a very difficult task. I worked for 3 banks for 35 years, still I couldn't become general manager. So it's a difficult task because of the hierarchy we have. However much you qualified, because there's only one position there. Just imagine all are trying to become general managers, it's not possible. I ended up with the deputy general manager, so I was happy. So what happened is in this structure, central bank wants to have this structure ready in the bank. Second line, what is in the middle is your risk management structure. Risk management also, they want you to divide your risk management department into credit, market, operations, if possible, IT, called information risk, which is also now considered a greater risk. Part of operations, but you know, since most of our channels are now on online basis and 24 hours, 364-day operation, therefore risk is high. There, all those lines will report to Chief Risk Officer. Chief Risk Officer need to actually and report directly to the board integrated risk management committee. But this need to be conveyed to rest of the business staff. So we have in between some executive committees for credit risk, market risk, and various other things. So Chief Risk Officer, before he goes to the board, he will deal with the business unit heads and do various discussions before you report to the board of directors. Then on your right side, what you have is a risk assurance team. Those are your auditors, internal and external auditors. They also have a board subcommittee called Board Audit Committee. They also work independently, so they give assurance of risk of this bank. So this structure is an important area. That's what I took. Your policies can be of various types. You need to have an integrated risk management policy because that's what the central bank wants. And these policies will be inspected by central bank supervision department when they come to your bank. You need to have a credit policy. You need to have a market risk policy. You need to have operation risk policy. You need to have liquidity risk policy. Now they have number of policies are huge. I used to keep another cupboard to keep the policies because when they come, you need to show. And every year now they want you to, if there's changes, you need to review those and get board approval. So not just because creating documents, you need to submit to the board saying this is the bank's policy and board need to approve that. Other one is the procedure. Procedure is very important because we work on certain processes. The processes come from procedures. These processes to work correctly, we need to document those procedures well. Now, we'll say we take a fixed deposit, which I discussed. I go to one, say bank A, I want to place 100,000. They give me a form. I fill it and write my details. Then give you another form. This KYC, I feel that also. Then they give me a slip. This is your account number, go to the cashier and pay. And I do them think that once all these documents are intact, that person who has the fixed deposit go to a person who will type the receipt, take it to two officers to sign. It will take longer time. That is usual process. But with the technology improvement, if I am a customer of a bank, my details are in the bank. If I want to open a fixed deposit, you should never give me a form. Form is used for you. You can fill it because my details are in the bank. If I have a current account, then details are I'm going to fill in the form. If I go to a more sophisticated bank, I say this is my account number. I type it, they will ask what is the amount you are going to put, what duration. Complete fill fixed deposit application will come and just need to sign it. So these processes will change time to time. That's what we need to do. You need to provide customer convenience to the maximum if you want to be in business. That's what you need to be strategically aligned to get more customers. So those procedures and processes are written in these procedure manuals. So in credit department, I can remember I joined new bank. They put me corporate department and gave me corporate. Next week you don't do any work. This week. This is the Bible of this department. That's what is it? The credit procedure manual. Unless you are thoroughly working with it, you can't do any work. And nowadays, I don't think those procedures are presented to people. Those procedures are actually just because central bank wants it, they create and keep in somebody's shelves. If you go to a new department, you should be given that procedure manual, then you will be very thorough by the time you start really work. So those three things are important. That's what this direction is all about. They say create policies approved by the board of directors, create a structure which is workable for your bank, but document all that, and then create processes and procedures that you find the best risk avoiding processes so that bank can manage risk better. That's what the integrated risk management is. So we have covered the second session also. Now we are taking these individual risk types for you to understand. I told most highest risk according to this balance sheet is credit. Now I am going to erase this because what is credit risk? It's on the board. I told you, we give money, take money from people who have moved. People who don't have money. Those guys, if they don't pay back, it's called credit risk. We also call it default risk. And also we call that risk counterparty risk. That means counterparty is your customer. Person who borrow money or lend money to the bank is a counterparty. Now, counterparty risk is people who borrow who doesn't pay. So, default risk is what you call credit risk. But credit risk can be again categorized in two areas. We call it counterparty risk. The other one is concentration risk. Now, concentration risk is created by the bank. I'll put it such a way. Counterparty risk is can be avoided. We say think before you leap or think before you jump. That means before you grant credit, do a proper evaluation to avoid the counterparty risk. But if you given credit and put them all in one basket, we call them eggs in one basket, and you trample that, and if all the eggs break, it is not the counterpart. Similarly, banks do this mistake. They give credit to one type of customer or one category of industry or one type of product. Some banks think leasing is my portfolio, all facilities will give for leasing. What will happen? COVID came and government asked all the leasing companies and the bank to give lease. Don't charge interest, don't charge installments for next 3 months. What will happen to you? Since it came from central bank, you don't have to classify those accounts as NPA, but you are not getting proper income. Your normal, you have to think of the cash value, money value, what you get today and what you get after 3 months is two different things. So we are working on interest. Therefore, if an account gets rescheduled or postponed payment, it's a loss for the bank. And concentration risk comes from our own fault. So therefore, we need to manage these two types. We need to manage customer defaulting. We need to manage that we are not putting all eggs in one basket. Therefore, central bank has given us 7 types of industries, and your board of directors will think how much money we should give to each type of industry. Based on that, we avoid concentrating into one type. Now, just imagine after the war, another booming industry was two things: construction and tourism. Bank thought that is the two best areas to lend and put all their money into those two areas. What will happen now? Tourism is the one of the most affected industry after COVID-19. So that type of risk comes from your environment. You will not know. Therefore, you need to diversify your portfolios if you are going to manage concentration risk. So that is credit risk. Then now I'm going to look at counterparty risk here. Counterparty risk is, you look at the right side. I divide credit process into two. One is credit management, one is credit risk management. And after 2011, when central bank introduced that paper, they say credit is not only the business unit's responsibility. Credit is the responsibility of the risk management. They said all high value loans also need to be ratified or responded or accepted, approved by the department. And that high value, they didn't say anything. Some banks thought anything over 5 million has to be ratified by the risk department. And I also thought so. So every day I go in the morning, I see 100 credit application forms on my table, which was a real headache. Thereafter, we put to the board saying high value would define saying anything over 50 million. It will be approved by risk department. Otherwise, all now banks have regionalized that, and they have put regional credit risk to approve low value loans also. So what we do here, you need to understand the process. I put the customer on this side. When customer comes to the bank and he presents the proposal, it's called loan origination. That's the time you give a form and ask him to fill what is loan, or you interview him, take all the necessary documents, and thereafter also sometimes you forget something, you call him and take other documents. That's the initial process. This entire process has certain risks. I want to ask another question from you. Do you like, if you are in the credit department, do you like customer to come to you, or you go to the customer? In this process, customer comes to you. Nowadays, bankers are much smarter. Go to the town, they see that fellow is having a four-story building. He must be a good credit for the customers. And you go and say, okay, I come from this bank. So if you need any facilities, we can help you and all that. Kind of business development you do. Why do you do that? Managing risk. Customer coming to you, you don't know anything about it. To identify a person in the town who is doing great, you have identified him to be a creditworthy guy. You are actually avoiding some kind of counterpart risk to a certain extent. Foreign banks, they call this cherry picking. You only select the cherries. You don't go to anybody else. Without knowing this, I practiced this very long time ago when I was put as a branch manager and I was asked to start a new branch in the town, which I didn't know a single customer. And those days, our general manager was very market oriented. He gave me a car, a driver, 200,000 rupees cash. This is in 1990, you may have not born me. You are going to open a branch in this particular town, you are going today. You do the marketing, get the customers. After 1 month, you are going to open a branch. I said, which building? No, you don't have building yet. You need to get a building on rent. You can look for that first. See the challenges. So I went home and took the directory of the telephone, started calling in that area number to various people. Some answers is that person is dead and gone for 3 years. That was the type of banking at that. So you did marketing, and without knowing this particular factor where you need to cherry pick, I went to the town. I didn't go to each and every shop. I just drove off 3-4 times to the town, look at whom I think could be a potential client, and then we look for some contacts to them, and then we approach them. In this particular town, actually, there are more than 150 shops. You open only for 3 customers in the town. That was cherry picking. And those 3 customers happen to be the best customers of other banks. So, when you offer higher facilities, they came to us. So best thing is to avoid your credit risk. Nowadays, banks follow this. They do business development, identify the customer, and then go and offer your credit. your loan origination will become also risk management type. Once the customer gets originated the loan, then you prepare something called to do evaluation. We'll take a corporate client. Loan origination means customer comes to you, you ask what you want the facility, then you either give a form or you ask various details of the customer in order to prepare a credit appraisal form. You will ask 3 years balance sheet, your company registration, company profile, what is your organization chart, what business you do, what is your product, where you market, all those questions you will ask, and then you collect all those questions, you put into a piece of paper, and that paper will go to a credit analyst who will do 2 analysts. One is financial analysis, the other one is qualitative analysis. Financial analysis is the one that you review. You can do profitability analysis, you can do, I think I send you a paper on this. I did some analysis of SLT dialogue. I did a lot of homework for you when I was doing what I did. I took, which I don't do generally, because I found it difficult to convey myself like this. So I did the analysis of 2 companies. One is SLT, one is Dialogue. I did Cargill's, I believe. Then I also did the commercial bank for you to identify. I went to their financial statements for 2019. I analyzed for you, and I did some ratio calculations also. Those ratio calculations, liquidity, current ratio, quick ratio, all that is are called financial analysis. So when those ratios are good enough, you think counterpart risk is get minimum. Qualitative analysis is customer's product, how he's going to market it, reputation of the directors, various other factors which cannot be measured in money. It's called qualitative aspects of a customer. And once you evaluate those, if those 2 are for your liking, what you do is you approve that credit. So counterpart risk is mainly avoided by evaluation. Evaluation can be a financial evaluation, can be a qualitative evaluation. So once you do that evaluation, you prepare a paper called credit appraisal form. And you can see there's a red arrow going into the credit risk department. What is going in that credit appraisal form? Because 2011, they say high value loans need to be approved by the credit risk department. So this appraisal form prepared by the business unit will move on to the credit risk management unit for further analysis. They will also see the analysis what you have done, because on this paper it is complete. Your ratio calculations are given, your qualitative aspects are given. They will look at that, but they do some other analysis also. Credit portfolio analysis. That's where I told you about concentration. They will see for which industry this particular request is being made. Now, you take nowadays, you get, if you are in the credit risk department, you get a paper, request is to purchase a hotel, tourist hotel. Now what do you do? And if you go to a portfolio called tourism, and you go to directories, instructions are please don't touch. Because that becomes most riskiest advance you can ever make. So you are a little bit jittery about whether you are going to do it. So you will evaluate this more and more times and do greater scrutiny because this particular request is pertinent to a credit portfolio which is risky. And you will ask various questions. This is where you recommend these take collateral. Take the hotel mortgage to you, take any other securities, whatever you can, because industry is not doing well. Probably the proposer, the customer may be a good customer. He may be having one hotel, another new hotel he wants to buy because the prices is low now, others are selling. And if you don't give, he's not going to be with you given the current facilities. You need to be careful, but at the same time, you need to evaluate. So, credit portfolio analysis is you look at to what industry this belongs to and what is your limits in those portfolios. Generally, we take the entire loans and advances to about 11 portfolios. These 11 portfolios include tourism, transport, manufacturing, trade, agriculture, various other categories. I will show that by chart. And then board of directors have approved a certain percentage for each category. And if that percentage exceeds with your request, you say portfolio limits have exceeded, therefore we cannot approve this loan. Then you have another called credit capital. This is another exercise generally the risk department does. They need to know how much capital you need to allocate to a certain facility. How do I explain this? Okay, you have customer A, customer B. Customer A is a AAA customer. Customer B is a, we'll say, single B. If you have studied Basel II, AAA customers' risk weight is 20%. You give a facility to a customer against his fixed deposit, what is your risk weight? You give a foreign ticket to a customer, what is his risk weight? Any facilities secured by gold, by customers' own deposit, central bank guarantee, or against treasury bills or bonds carry a zero risk weight. But other than that, customer may give you various other types of collateral, but if his credit rating is the determinant of his risk weight. So AAA customers generally carry, single B customer carries 100%. He may be giving property, maybe 5 million, whatever, never mind. We'll say both customers wants to borrow 100 million. And this guy says, I want 100 million clean. Don't ask me for collateral. I want this facility for 10% interest also. He can demand because he's a AAA customer. This customer, 100 million, he give a 200 million property. And he says, apply your sheet rate. Your sheet rate is 14%. Whom do you like to give this facility? Customer B, you have a collateral. The guy is demanding customer. He says, I want this facility for 10%. You give some customers 10% deposit rate. The other guy is an innocent character. He can't demand because he's carrying a no credit rating, and you know his risk rate is 100 compared to customer is 20%. But he is a demanding client. He says, I don't ask for any collateral, give me a 10%. What is your decision? If you are a bank which doesn't have much capital, you select this one. Why? You need to keep of this 100 million, risk rate is 20%. Then it is 20 million. Your capital adequacy ratio is 10% of this, which is 2 million. So you need to, if you want to give this facility, you need to reserve 2 million out of your capital for giving facilities to A. B, you give 100 million, risk rate is 100%, so you have 100, 10% again you have to keep is 10 million. If you don't have much capital to reserve for this facility, then you select A, because otherwise you have to give 5 times more capital to give a facility to customer B. That is what you call credit capital. We have certain banks who doesn't have capital adequacy ratio, so they look for highly rated customers to give. Because they can't give more capital for and create more risk weight in their balance sheet. So banks on the risk management side, they evaluate this risk capital and see whether large amount of risk capital has to be reserved. They will comment on that, saying, good, this has a collateral, but however, we need to keep capital. And if bank doesn't have much capital, we have a problem here. Adherence to policy, procedure, and lending guidelines. So I told you the guys who are in the credit risk also will have to read the Bible. And they must make sure the appraisal form what business will send in line with all the policies. Then we have, after that, they also give approval, and then the facility will be given. Once approval is done, to go to take whatever collateral what is been described there, to disperse the facility, and then the business unit will monitor. If it is a high value one, central bank directs every 3 months for you to do a review. This is what you call credit process. So we learn how to manage counterparty risk. This is what you call portfolio. And these are the types: agriculture, manufacturing, tourism, transport, construction, traders, construction, new economy, what you known as new economy. .com companies, all IT companies are in the new economy. Then financial and business services, infrastructure, other services, all credit card, pawning and personal loans, etc. So central bank has categorized the industry into 11 categories, and each portfolio has a limit set by the board of directors. So if it is within that portfolio, this is to manage concentration, not to put all eggs in one basket. And generally we do this at the time of budgeting. This slide was done in 2013, very long time ago. So, we had 143 billion in loans in that time, and it has been budgeted to increase to 152 billion. And this was our proposal to board of directors. We had to increase. Now you can see we requested the agriculture to increase from 9.5 billion to 15 billion. Sri Lanka is an agriculture-based country. With the new government coming, what do they want? They want you to grow local. All what we consume, we actually that's the area. There's a lot of prospects. However, Sri Lanka agriculture is managed by small times. We don't have large farms, we don't have large agricultural sites. As a result, produce what you make, they cannot sell, don't have market, all problems are there. I think with proper management is one of the very good growth area and an important area. So central bank now says every bank at least 10% of their total loan portfolio needs to be given to agriculture. The direction from the central bank. So it's an important area. During that time, tourism was 2,772. We requested to make it to 6,000. If we are doing this year, probably a board of directors who has a 6 billion portfolio, they will ask you to reduce to 2 or 3 billion because prospects are so good. So when you do the budgeting, you adjust these portfolio limits. This portfolio limits is also known as risk appetite of the bank. In other words, you want to learn risk appetite is the amount of risk what you want to take. So risk appetite can be described by way of a portfolio limit, or risk appetite can be described by the delegated authority what you give to your officers. You know each up to how much you can approve a loan. You have a delegated authority. And up to how much. I don't know how you operate. Within what you can get. I was a branch manager. I had a limit of, this is 91. I had a limit of 2 million. 2 million is a big money at that time for secured loans. 200,000 clean loans. So you could actually promote credit, otherwise. But I also had several branch managers who had given that credit to 50,000. So one central bank in their 2011, they also specified delegated authority or the risk appetite of an individual who takes responsibility in credit is not to be based on his position or the grade. It has to be based on his ability to give credit. They later increased my limit. I didn't want to say it. They know I don't give. Because sometimes you become branch manager, the night where you can't sleep. You can given facility. So, delegated limits also kind of a risk appetite. So credit we have covered now. two parts. You need to know the process. You need to know concentration. If you know these two areas, you can manage the risk. I didn't go to evaluate and all that. I also can show you what, but I have done a lot of homework and given you during my online sessions. Shall we take a break? Or you want to continue? We'll try market risk also then. Market risk is simple. There are 4 types. Market risk is also called price risk. Price risk means the amount of money what we charge from a customer. We don't give money in the stream, we charge the interest. Interest is the price what we get from the customer. Similarly, so this price can change. This price can change based on various aspects. Now, COVID-19 creates a complete havoc for banks because government thought now credit facility will be completely restricted by banks because of people have been affected already. Your NPAs are rising. Therefore, they thought you need to stop giving credit. But government thought if you stop giving credit, there won't be any economic revival. People will stop producing. Already your gross domestic product is at a very low. You need to increase that to have an economy going. How do you do that? You need to produce more. Produce more, you need to have low interest rate in the market for people to borrow. What central bank does is they have a policy rate, which I think I sent you a document also, published by a former deputy governor of a central bank, which I picked up from the paper and I also sent to you, because that's a very important area. Central bank, with the instruction from the government, they have a rate called policy rate. Policy rate can be a deposit rate and a lending rate. So they call it standby lending rate, standby deposit rate. If a bank has excess money, they will deposit in this scheme and earn about 5.5%. Bank need to get money from the central bank. They need to borrow money from the central bank. They will charge 6.5%. Now this rate was something like 10% earlier, 8.5%. Now I think it's going at about 5.5% and 6.5%. So money is become cheap now. You get money at a very low price. So banks had to reduce all the interest rates on facilities because of policy rates come down, and once immediately policy rate come down, that's a big advantage for bank. Your treasury department will make huge amount of profit because they have invested in treasury bills bonds at high interest rate instruments. Your treasury bills were rated at 10% or 9%. Now you can buy the same treasury bill to same value at 6%. So what the treasury does is they will sell those high interest rate at the high interest rate value and buy a similar value treasury bill with a low interest rate and balances their profit. So treasury started making a lot of money when other units are not making money. when interest rate comes down, you are holding an investment in bills and bonds with high value interest rate instruments. You can go to the market and sell them at, we call it coupon rate, and you can make immediate profit. So interest rate is risk is one. Now here we have an interest rate come down. Now interest rate come down, what will be the effect on the bank? If you have high value interest bearing treasury bills and bonds, you can go to the market and make profit. No risk. Interest rate come down, you have accepted deposit at 10% or 12%. Now customers are demanding loans at 8%, 9%. What will happen? You need to give. Whereas your money supply has come at a high interest rate, then you will be making losses. So interest rate is, we call it repricing. Moment interest rate come down, you cannot reprice your deposit at that rate because those deposits have been accepted fixed rates. But customers who have loans, they will come and say, market interest rate is this, please reduce my interest rate. You can't tell those customers, we have given this money to you based on the interest rate what we have paid to our deposit. You can't say that. It will break down. As a result, we have interest rate risk. The second one, we do foreign transactions. You must be much more aware of our Nostro accounts. If you want to do business in UK, you need to have account in the UK bank, using Barclays or Midland or whatever, and maintain account for them. If that account for transaction at the end of the day, you can have a debit balance or credit balance. And you total up all those foreign accounts and you convert those balances based on the middle rate to US dollar rate because we have a US dollar based country. So what we do, we take our position based on US dollars. So you may have Swiss francs, you may have sterling pounds, you may have euros. So you take debit or credit balance, you convert into dollars and arrive at a position at the end of the day. That position can be a minus or plus. If you have surplus in those accounts, you have a long position, we call it. Otherwise, you have a short position. And we'll say today that position is, we'll say you have $1 million. And the rate is, we'll say 183. So in your balance sheet, you have 183 million as foreign exchange. Now this is long position. That means you have plus. Now tomorrow exchange rate fluctuates to 182. What will happen? Tomorrow your balance sheet will be 182 million. What you are going to do the difference? 1 million is your forex loss. That is foreign exchange risk. Change of exchange rate sometimes give you profit, sometimes give you less. And when you create a loss, it's called foreign exchange. Then the third item is, we'll say your bank invested in shares. We'll say John Keels. Say 1 million shares, bought at, we'll say 120 million. Today's rate is 123 million. So you have make a capital gain of 3 million on these shares. Later, you know what happened after the COVID? No? All share price went down by about 10%. And JKH fell to about 89. So your 1 million shares now it is 89 million. Just picked up again. I'm just for hypothetical sake, I'm telling. If you had to liquidate it at that time, you will make a loss. That loss is called equity risk. So equity risk is managed by your investment committee. They will monitor all the companies whom they want to invest. They will see what is their investment. There are various techniques called stop loss limit. If the shares is going down, investment committee will decide if it goes more than 10%, they will sell even at a loss. And they will arrive at the profits looking at the company's forecast, how much profit they are going to make. We call it company valuations. So if the valuations are on the high side, they will keep on. If they reach the maximum, at that point they will dispose and collect the money. So another risk what we take is the equity risk. So finally, we have commodity risk. The other countries, banks deal not only in, they deal in various commodities. Not that they are going to keep it, they deal oil on paper. They deal in copper, lead, whatever metals they can do, they do trading. But in Sri Lanka, generally most of the banks are dealing in only in gold. You can buy in the international market gold and hold as your investment, and you can get permission from the central bank to sell it to local goldsmith when the prices are high and make money. So if the prices fall, what you have is a commodity risk. If you have bought gold at, you say, $1,350 pounds and sell it for some time and it is always going down, you have to dispose at a loss. We call it a commodity risk. Generally, banks nowadays gold is on the really high side. Held no losses, they are making a lot of money. So that is very simply market risk. Market risk is measured in various techniques. And those techniques which I have discussed are sensitivity tests. I think if you look at it, I have given, I think, two or three charts in the workings which I have done. This is for interest rate risk which I did for government securities portfolio, holding a portfolio of 9 billion. That was your original book value. Then they look at the date, that is called market value. I already made 6,815,000. Then please imagine saying interest rate will either increase or decrease by certain basis points. Basic points means 300 basic means 0.3. 200 is 0.2. Similarly, we looked at the decrease of 200 and 300. Then we will see what will be your market value of your portfolio. And you see 300 points increase, your market value will shift from 9.5 billion to 9,007. As a result, you have a loss of 566,000 loss in that category. So that is we call it. Now this 10%, 20% is a hypothetical figure in what we got, 300%, 300 basis and 200. We need to move into much definite change, then we consider a test called stress test. Stress test is you create a scenario. As a result of this scenario, definitely your market value will change by this number of points. And then you calculate your portfolio into that and arrive at the loss. That is your market risk on interest rate for your government bond. We did this for your exchange positions also. We did change of percentage of your rate. Then we did for equity also in this. So these three calculations you can study further as a measure of looking at the market risk.
අපි අර සෙමෙස්ටර් BA කියන සබ්ජෙක්ට් පහක් තියෙනවනේ. අයින් තුනක් තමයි කරන්න ඕනේ. මේ දැන් අයිතියෙන් ඉඳලා අපි ෂෙඩියුල් දාලා ඉස්සර ගන්න හොනාලියලා. එතකොට මේ අවුරුද්දේ බැජස් හතරම කරේ හතරක් පහක් වගේ උදේ සමාජයේ ලෙන්ඩින් and project finance, fundraising and credit management, marketing management. මේ සබ්ජෙක්ට් තුනම ඕගලන්ට කන්ටිනියු කරනවා කියලා කරන්නද? කරනවා මේ ඒ කියන්නේ past papers අරනවා කොහොමද කියලා නැත්නම් අනිත් සබ්ජෙක්ට් එකක් තමයි global financial instrument packaging management. හරි? දැන් ඔයගොල්ලන් කොට දැනගන්න කරන්න ඕනේ දැන් අම්බෙන්නේ කියලා. හරි. අවුරුදු රෙජිස්ටර් එකේ සබ්ජෙක්ට් තුනක් තමයි ඒ කියන්නේ
Aduh ya.
management subject එක කරන් යන්න
Kita bawa ke tempat ini. Management on subject. Minutes we'll have a break. In 10 minutes, I think I'm going to power operation. You see this definition: inadequate or failed internal processes, people, systems, and external events. You create operational losses due to this. You have these tellers on the counter. They are taking the most risk because they have to deal with money, pay, receive, and all that. If a teller is short, what do you call it? Operational risk or any other risk? How can a teller get short? Have you ever worked as a teller? Huh? You tell me how you get short. Because I also worked as a teller when I started. When I joined the bank, they said, you have to work in cash first. That time we don't know even how to count because we have not handled that amount of money before that. We never had counting machines. We never had even a calculator to add up. You were given a scroll book. You need to enter all the people. I was put on receiving counters. And they say a very simple thing. I give you a procedure. That's what I said. Process. To accept this, if you go according to this process, you will never be short. My officer said. You know what he said? You take the money from the customer, take his slips, keep the money on one side, turn the slips on the other side. There's a stamp called denomination stamp. Now I think denominations are printed only on this. Those days was never printed because they didn't have double-sided printing facility in those days. So only one side printing was there. So we whacked the stamp on the device. Take the money, count, don't put it in the drawer just because you count it. Count it, write your denomination, total up, recheck the total, and then turn the slips on the side. And that, if your value agrees with that, your cash into your drawer. So if you follow this process, you will never be short. But I was short one. That's not because I'm not following the process. It's a very mad thing, but we had two tellers. And the guy was actually, he's a Muslim guy. He need to go for prayers at Friday 1 o'clock. And so I used to cover both counters. He's so religious minded, so I agreed with him. Those days we opened till 9 to 1:30 because that's the most busiest time, so I allowed him to go. Those days we didn't have these slips. Customers are given deposit books. So one customer actually brought a book taking 2 slips. And he generally known customer, I accepted one deposit and put the stamp, and on the receipt I kept the book. And the slip was there. Then this guy came and asked me, did you take the money on this? I said yes. He put the stamp on that and signed both slips. Customer took the slip away. And now we are left with the deposit slip without money. Amount is 1,000 rupees. And later we knew the customer, we called him and said, look, I accepted your first deposit, second deposit didn't have money. And book was left here, my friend made a mistake. And he said, no, I gave 1,000 rupees. So this went to the management. We knew the customer. And they didn't believe us. They didn't believe both the staff. They said, no, you got to pay. And they started deducting 75 rupees from our salary. For the next time to come, don't ask me what was my salary that time. 412 rupees. So deducting 75 is a huge impact on both of us. We were very unhappy. And one of the senior, he was the assistant general manager. He came and asked me what happened to that customer. He said, look, we did the right thing, but there was a small mistake on our part. We didn't follow the process well. And this is completely a mere. He said, call the customer for an interview. So we got the customer and we confronted him with the general manager. He became a chairman of a bank thereafter. So he asked the customer, did you give the money? He said, yes. Do you want me to believe these two boys or you? That's the only question he asked. He just said, 1,000 rupees for a businessman of your nature is not a big amount. But 1,000 rupees for these two boys, we were very young. I was just 18 and 6 months old. So my friend was just 19. We just joined the bank. It's a big money for them. Then he said, no, I gave you. The assistant general said, I give you two options. One is to pay 1,000 rupees to these two boys or take your account from us. I don't think nowadays no bank will do that. They always believe the customer because they want the customer is more important than the staff. Apparently, this guy didn't want to close the account. So processes are very important if you have to manage operation risk. And so processes people are staff. If I would have been fraudulent in doing that, that is operation risk again. But we were genuine, but we lose our money. Systems and from external events. External events can be coming from bank robbers, hackers, all those could happen in a bank. So operation risk has become a huge threat to bank. People never thought operation risk will be a major risk to impact. But risk department now identifies and they actually identified various issues where operation risk could occur. And we call it you do a chart like this. And we put low, medium, and high. Frequency on one axis, impact on the other. And if you have now this cash shortage, which was very frequent, so it could happen here, but the impact was only 1,000 rupees, so I put here. How do you manage this operation risk? It happened to me. You tell us all the time. Frequency is high, but the impacts are low. You need to improve your internal controls. Operational risk are managed with mainly low value, high frequency operational risk. You need to take, otherwise you can't run the business. Therefore, you need to have good controls. That's why your auditors go frequently visit your branches, do the inspection, see that internal controls are there. Why your manager can't go and open his drawer alone? He may have access to combination, but the keys are with somebody else. That is internal controls. You prepare a voucher. Now the supervisor will have to sign. That's the dual control on a voucher. Second, I will see If you only have to do that transaction yourself, just imagine you're on a foreign exchange account. Customer comes and give you $1, you apply the exchange rate of sterling, you make a loss. Fortunately, you have another supervisor who will look at it and they authorize the voucher. Then operation risk can be avoided. So internal controls are required to avoid operation risk. Now, you'll see your cash transport van going to load your ATM machines outside, and it is being dropped. Frequency is low. It don't get dropped every day, so it will come somewhere here. But if they lose that money, impact is high. Not like your teller losing 1,000 rupees. How do you avoid this? Your cash van is being dropped on its way to load the ATM machine. 20 million rupees have been lost. Operation risk. Earlier one, you have internal controls. Here you have no controls. It is gone outside. You send guards, but you know anything could happen. You don't send this van without an insurance cover. What you do is you transfer your risk from the bank to the third party. So if it is high value, low impact risk of operation, you always get an insurance cover. You transfer that risk to somebody else. This is how operation risk is managed, but operation risk also I need to do. You need to identify because you cannot measure in terms when it happens. So we have a procedure called, you do a exercise called RCSA, Risk Control Self-Assessment. That means your risk department in the operation unit will ask all the other departments in the bank, please tell us what kind of operation risk you will get. Clearing guys will tell something else, cash guys will say something else, your foreign department will say something else, the documents they need to keep your control. So you look at all that, and then we say, we also record previous losses, and we see that there's a pattern. We call it loss data. So once you do the RC exercises and identify the operation risk, and also collect previous losses, and then there's another new thing called near misses. Now say I prepare a voucher with the exchange rate of sterling. Supervisor caught it saying that, then what do? You tear off your voucher and prepare a new voucher. But what is the lesson learned? Applying of the wrong exchange rate. And this loss, this near miss has to be recorded somewhere. Once it happened to me, actually I asked this question, that time I was not doing risk. We in a bank in Japan, and I went and exchanged the traveler's check. Went to the counter, that person gave me a tray, kept my traveler's checks, then somebody came outside, asked me to sign it. He took it, gave it to the teller. I didn't give the, I just signed it. Then the token number is given, I received the token flash, I went to the counter. Once again that person came from back, took the tray, took the money, and counted again, then only gave it to me. Then I asked, I am also bank, but we don't practice this. Why you have another person coming and counting cash and giving? That time they said to avoid operational risk. Actually, that person told me a nice story also. He said he make a lessons learned out of this. One of the teller paid a tourist higher value than the touristic's value. And that tourist has come back after 3 days and given the excess money what he has received. Their manager refused to accept this money. Because that time he has already debited his profit and loss account as an operational loss. And when the money was given, he refused to accept but put as then has shown that this is a gift for you. And says no, that tourist has anyway left the money, but this is recorded in their lessons learned book in operational risk. That money I don't know where they allocated it thereafter, but they say the manager refused thereafter. The remedial action to avoid that operational risk is to have another staff member who is doing the second count, because it's a bank which mainly operates for tourists in a train station. So they have a lot of tourists. Importance is to serve the customer and doing the internal things, so they can afford to have another staff member doing the recounting of money. So operational risk is like that. So we need to have risk control self-assessment exercise, loss data, near misses. Once you tabulate all this, you will identify whether it is a high impact or low impact or middle impact. High frequency of that. If it is high impact and low frequency, you need to get an insurance. If it is high frequency but low impact, you need to enhance your internal control. This is what the operational risk is in 10 minutes. But I have given you more notes on that, you can see. We'll take a break now. Information risk is also part of operation risk, but with the advent of online banking, internet banking, phone banking, ATMs being used very widely in delivery channels. As delivery channels, we have been exposed to information risks much higher level than what it was when you are doing only the branch banking. So we'll see information security has become a very important area, and now central bank identifies this as a key threat to banks, and they also actually created safeguard methods for banks. And what you need to is any loss arising from inadequate organization, failure, sufficient security of the information system. This can be threat from external sources as well as, if you are not up to date with your technology, can create certain losses, also come under the information risk. So information security is called state of being protected against unauthorized use of information assets. So if you have to go further, we have two other: information security and cyber security are two things. Cyber security deals with any criminal activity against your digital information. Any other assets are covered under information security. So there are two things. Cyber is only for the internet aspect of it. So you need to safeguard this. This is a very important area. You need to have security in your data center. Data center is your computer center, because computer center should not be accessed to unauthorized persons. Generally, most of the banks, you need to have a kind of a security entrance to enter that. Only the staff who are actually in that particular center working are only allowed there. Other than that, you need to have some authorization card to enter. Security assets means your computers, servers, network, all that is your security assets. And you need to safeguard them in order to avoid information risk. Security of data is done by password protection, encryption of sensitivity data, and backups and firewalls. So you should be able to see how many attacks on your firewall in a day and see whether your current firewalls are good enough to sustain those attacks. Then other thing is the frauds. Fraud can only not be done by hackers, but also one of the fraud was very common until this chip-based cards came is card skimming. So they actually duplicate a card or make a duplicate card out of a customer's thing and draw money out of it. And when he presents saying that I haven't drawn the money, bank is liable and become a information risk. So banks have taken a lot of steps to avoid information security risk, but yet there are instances where, even recently some bank in Bangladesh, they have attacked the firewall and transferred money out of their treasury account from one to Sri Lanka, one to Philippines, billions of dollars, and fortunately local one, the bank didn't transfer it to the customer's account, and they had inquiry and then found it was a kind of a security threat, security violation of another country. So when you're on the internet, anything could happen. Therefore, you need to understand the information security also. But central bank you support, you need to understand there is a circular issued by something called baseline security standard by the central bank. And there's a team, emergency team has been created to come up and save banks from this threat called CERT. So central bank under their supervision, when they come to inspect various other risk aspects, they also look into the information security aspect. As a result, now new position has been created in banks called ISO, Information Security Officer. Other than the Chief Risk Officer, they also have a compliance officer. So when the securities, when risks are high, different challenges come to the bank, and then responsibility will be get assigned to various people. So this is in nutshell. I think if you read this, mostly it's understandable. I think you understand technology better than me, so I don't have to tell further. We'll move on to regulatory risk. We have 2 or 3 info areas. So what I thought was we'll complete the revision today rather than going into the. So I took the liquidity risk also. So we covered in nutshell. Liquidity risk also important area for you to ponder because it is something to do with cash flow. Generally, banks, we have an assets and liability management committee which forecasts your funding and your disbursements. Funding can come from your deposits, can be term deposits, bank debts, or capital infusion. You can borrow money or you can accept deposits in order to source funds. If these funds will be utilized to create assets. Assets are your loans and advances. So that's the basic concept. Then liquidity management, it's actually more you keep liquidity, more you're going to lose. So it's a balance between your liquidity and profitability. And keeping in mind of the latest trend, now what did COVID-19 did was create a situation where banks' assets which are payable cash flow from assets stopped. Similarly, people who have surplus money, when the interest rates were brought down, they thought it's better to keep it there, umbrellas or whatever, rather than giving the money because the interest is low. So both sides, banks were squeezed. So now bank is in a position, they are in a position to, they were asked to lend. And you can't keep lending because you have another regulation from the regulator that you need to keep reserve ratio of 7% and 21% of liquid assets ratio. So when banks got squeezed, Monetary Board of Sri Lanka identified this. And they gave a lot of concession on how do you classify your liquid assets. They even went to the extent of the senior citizens deposits we pay 15%. Bank will pay normal rate, balance will be paid by the central bank. Now the central bank money won't come, even bank pays interest. They will pay the central bank for a long period. And they keep a provision for that. And that provision also was considered as your liquid assets. Similarly, a lot of concessions are given by central bank to improve the liquidity so that banks will disburse more money by way of loans to affected customers. So this is one of the phenomenon what we are in now after COVID-19. Though we have restrictions, the restrictions have been released to a certain extent by the central bank in order to create liquidity. Well, it's a dangerous situation because one hand you give loans, if they are not coming back, the regular payments are not coming back, liquidity will get dry. And on the other hand, central bank is asking you to give more loans. Then whatever liquidity you have, you get into customers' hand. And if deposits are not being mobilized, you will have a problem. So under this situation, we have a liquidity risk management has become important under nowadays. So what we do is when the liquidity, high quality liquid assets, this is what the international requirement now. Apart from SLA, that is statutory liquid asset ratio, now banks have been asked to maintain liquidity. Another criteria from the Basel called liquidity cover ratio. Now, they say stock of high quality liquid assets divided by total net cash outflow over next 30 calendar days would be either equal to 100 or more. This regulation came in 2019 and still stands. But central bank has eased what is termed as high quality liquid assets. They have given more items to be added into high quality. Therefore, your stock of high quality liquid assets now got increased. As a result, now you can plan your liquidity much more better. But what they're going to achieve on this ratio is to see whether you have enough high quality liquid assets to manage your bank for next 30 days. Generally, if you can survive for 30 days, you can make adjustments. So this new ratio called liquidity cover ratio is It's a very important ratio. It came from Basel Committee, and this came as a Basel III Accord. So, where liquidity management, where Basel III is concerned, they introduced this one and also another ratio called net stable funding ratio. There again, what is stable funding? Stable funding is based on your past records, you determine that in a month you can raise this amount of money as your funding. That means deposits will get rolled over, new deposits will come, all that you make a computation and see in a month your loans will get repaid, this amount of money will come. Then also you need to calculate in a month what will be the outflow. That is available amount of stable fund, required amount of actually both not available, the other one is required. Required amount of stable funding divided by available amount of stable funding should be more than available is on top, required is on low, and then it has to have more than 100%. So this is another ratio given by the Basel Committee as Basel Accord 3. So liquidity is concerned, we need to maintain reserve ratio of 7%. We have a statutory liquid asset ratio of 21%. And we have a liquid cover ratio that has to be more than 100%. And we have net stable funding ratio, which also must have more than 100%. So if you are going to report liquidity risk, these 4 ratios you have to remember, and questions will be on these ratios only. The other risk type is regulatory risk. Now we have covered credit, market, liquidity, financial risk. Then we have done operational risk. Then we have done IT risk. Then we did, I think that's all we did. We need to cover regulatory risk and strategic risk. So regulatory risk is central bank has issued guidelines. Actually, all the banks have been managed by one act which has been passed in Parliament called Banking Act in 1998. It is very old. But time to time, what central bank is doing is, like our state constitution, it get amended or new directions will come. So every year, directions have been issued to licensed commercial banks and also non-banking institutions by the central bank as guidelines. How do they manage? So they are called directions. Directions are published by the central bank and been informed to the banks. Banks are required to follow that. And those directions can be for various types of risk. They can be for credit risk, they can be for market risk. So when the direction comes, banks will have to determine what type of risk it affects the directions. And now the banks have been asked to appoint a person who will be independently checking that any violations. Actually, non-compliance means you are not adhering to the directions given by the central bank. So regulatory risk is non-compliance of those directions. And those directions, what will happen if it is not non-compliant? Non-compliant will lead to fines. Non-compliant will lead to, finally it will be cancelling of license. Has it been happened in Sri Lanka? Pramuga Bank was a non-compliance risk. One of the example is actually the bank was closed due to compliance risk. They have been given various directions and not following that. Finally, central bank will have to come and seal the place. Similarly, I think time to time they do various fines for that. If you are not maintaining your liquidity asset ratio 21% for say 3 consecutive times, sometimes banks will be fined $500,000 of that nature. So central bank will induce somehow banks to comply with this. So it relates to capital adequacy. Now I think we have some banks still in Basel III, capital adequacy ratio has been increased from 10% to 14%. Banks which doesn't have 500 billion asset base to 12.5%. If you are not having enough capital to support that asset base, you are non-compliance of the capital adequacy ratio. So overall period, they will look for this certain period. So some banks are given permission even to bring in new investors. Even foreign investors were allowed to create that capital requirement to avoid the financial risk for the financial system. If they fail for a long time, next step would be those banks will be asked to consolidate with another bank. Apparently, this process was going for some time, but it was stopped somewhere in 2015. Otherwise, we would have ended up with few banks because lower capital banks were asked to amalgamate with high capital banks to make regulatory risk, to make a sound financial system in the country. So regulator risk is also very important. If you miss that, if you don't obey your hierarchy, you may lose your job. Similarly, I think banks, in order to operate, they need to, apart from this, now we have new threats, especially money laundering. Now, government is after all those underworld gangs, and as a result, some banks may get exposed to, non-compliance of KYC, and that's a very serious issue because that non-compliance, not only banks will be penalized, the staff will get penalized. I know non-compliance of KYC, staff can be fined either 50,000 rupees or 6 months jail term. So it's a very serious thing. We need to take guard of it. So compliance is an issue where KYC has become a very important issue to avoid the money laundering activities. Next one is our and somebody raised hands for strategic management. Strategic risk is also for the bank because I have put this slide. What is strategy? That is a long-term direction. If you don't have a direction or plan for next few years, you don't know where we'll stand after that because banks now operate in a very volatile economic environment. Things are changing so fast. I think after COVID-19 has given a good lessons for all economic activities in Sri Lanka. We have moved from work from home, all that came up with this. We never thought this sort of thing will happen in the world. So things are changing so fast. To adapt to that, you need to have strategies. And the strategies are of a long-term plan. And the risk manager's function is to see that those long-term plans will not fail. So strategic risk is actually a direction or scope. We need to predict the future risk. Strategic risk goes along with our stress testing. Stress testing is a future kind of forecast to see. Recently, someone wanted a question. How would be, what type of strategy banks should adapt to avoid non-performing asset build-up due to COVID-19? I said, even a risk manager, I can't think of it. Because we don't know how long the COVID-19 is going to be there. Fortunately, Sri Lanka, we had only 2 months lockdown, and then we started work. And but if there's a second round of COVID-19 comes, I think we are not prepared this time. Because if you see, already these health violations are taking place all over, and even I am violating without a mask. But I keep my distance with you. So, but what happened is, strategies actually do with customers and competitors. Now, strategic risk will come from external factors. Competition from peer banks with low-cost funds, with innovative products and systems. We have 26 banks. You don't know what strategy your competitor bank will take next time to attract deposits. Fortunately, banks work under one tight regulation from the central bank. We cannot undertake other banks' interest rate by giving high interest rate to canvas deposits. If that happens, others will follow quickly, and then it will be curtailed. They will change the customer target customers. Now, you see most of the guys who are not even computer literate have now opted for online banking. There's no alternative because they can't find another way of operation. So your target customers' behavior cannot be predicted. So it's a big strategy you need to have. Think. Technological changes and ability to adapt to such changes. This is one of the greatest challenges we have. Dynamic global and economic indicators. Now, global and local indicators. In Sri Lanka, we have a GDP of, in 2015, it was 5.6. Gradually, it came down. I think towards beginning of this year, they were forecasting something like 3.5. Now, the forecast for December for the year by Fitch says 1.5, because economy will get affected to that level, and then what will happen is when GDP comes down, gross domestic product is an indicator of how our economy performs, and it is get linked to various things. It get linked to various risks. You will have credit defaults because when growth is low, income for those guys who have manufacturing will become not enough and they will default. Then when they default, when the money is not in circulation, go into recession, and depositors will not place money in the banks. So our funding source get restricted, our revenue source get restricted, and we may not have the profits what have been forecasted for other years. Sri Lanka, we generally always on the growth trend. all the banks are forecasting they will make more money than this year. Their asset base will grow more than that. Deposits will grow compared to previous year much higher. Advances will grow, but all those indicators, those are, we call it key performance indicators of a bank, will get affected due to this situation. So dynamic global and local economic indicators will actually kind of a strategic risk. Regulations and compliances. These also will come into force. Now we'll see, we may have a lot of customers in diverse fields. You may have customers who are in motor trade. What is the situation now? They cannot import. And when they can't import, their cash flows will dry, NPA will result. So these regulations, not only to the bank, but to various customers, will also create problems for the financial institution. So we need to be very thorough with this strategy. And all the other banks also will follow this. Therefore, we need to do something, but others have not done in order to survive. So strategic risk is a great area where corporate analysts will have to look into, and risk management will have to participate in new product development. Especially in banks, we may have to create new products to cater to different needs now, because some banks who immediately got the customers to, even online access it, get an online bank account without even coming to fill a form. That's a strategy. So this kind of thing you need to create. And risk management will have to find out what are the risks involved in doing that. Now you see, I have, we'll say, normal account, which I didn't have the online facility. And those days, if I need one, I need to come to the bank, fill a form, I have to give my password, then get it. But now banks have asked you to, you go online, you create your own identity, your password, and then they will certify it. They are after your own. How does bank know that I am the real person? They have few questions to ask and various things to verify, but fraudulent guy can create havoc in a situation like that. So risk management will have to say, any new product development, they have to see the risk involved in that. So these are the source of strategic risk we need to identify. We also will go into another area called corporate governance. This also become part of risk management. Actually, this portion has to be done by the company secretary. And we have this Basel II regulation. Basel II regulation, the first pillar covers with capital adequacy. Second pillar is called supervisory review. Now what happened is Basel II, when they introduced, they said you are computing the capital adequacy for your risk weight of credit, market and operations. But you remember the risk types what we talk? We talk about reputational risk, we talk about technological risk, now we talk about strategic risk, we talk about liquidity risk. All that is not covered in that. But the supervisor wants you to identify yourself whether you are subject to this risk. If
it is so, keep additional capital. Now to do that, you banks need to do an exercise called ICAP. Have you heard this? That is Internal Capital Adequacy Assessment Process. And every 6 months, you need to submit the document to central bank identifying, other than operational credit and market risk, any other risk which banks encounter, and propose what you have done to mitigate them. And then if that document will go to, after board approval, it will go to the central bank. When the central bank has that document, they know the type of risk the bank is subject to, and they might even ask to increase capital requirement to support those risks. So ICAP is the second pillar of part 2. Second pillar of the part 2 of second pillar of the Basel II. So then, apart from that, third pillar is called market discipline or disclosures. Now, when this came up, the central bank again brought another circular called corporate governance. Corporate governance it's about transparency and fair deal to all your stakeholders. So, what they want to achieve is make your directors responsible. Those days, you become a director of a bank and you have a very prestigious position without much responsibility on you. But now, if you are a director of a bank, people don't take up directorship in a bank. They are looking for experience, knowledgeable, qualified people to be in. They also call it fit and proper persons. Fit and proper in the sense, not in fit, you go to a gym and fit yourself, but they have a complete good track record of financial management, even in their previous directors. So they look for very qualified people who are responsible of managing a bank without allowing the financial system to get disturbed by the activity of that particular bank. So they say fair deal to stakeholder, promote good governance culture in the bank, hold board responsible for risk management. That's why we go in, because corporate governance I told you that we create subcommittees on the board. One of the subcommittees, Board Integrated Risk Management Committee. You get 3 directors coming into this committee along with Chief Risk Officer, your CEO, and various other business heads will participate in this committee. And this Chief Risk Officer will present the status of the risk in the bank, and then you discuss how to mitigate. So it's a very important subcommittee of the board which work in managing risk. So corporate governance give banks, boards to create that board integrated risk management committee to have right people on the board. So there are various things. You have to go into governance, you look at the board's responsibility, kind of composition, fit and proprietary aspect of it. I go last one. These are the subcommittees which board need to appoint if you are to manage your bank proper. Certain liability management committees should come under the purview of the board, because that's where the liquid risk is managed. Bank's performance will be managed. Integrated risk management will cover the risk management aspect. Internal audit and controls. Board audit committee is a subcommittee, because this is where you give the risk assurance. And then HR and remuneration. Your Now, actually, after the COVID-19, there is a direction from the central bank which says additional allowances to your directors and key management personnel should be stopped. So that will come under the HR and remuneration subcommittee. Simple reason is when there is a crisis in other countries, top people will create profitability, high profitability in a crisis situation, because mostly directors and senior management allowances and salaries are linked to performance. And when the performance high, they get 6-month bonus. Now we have a situation, the performance are down. And yet you are demanding your allowances. So central bank has intervened and curtailed them already. So these are the 4 areas where board committee is important. I think another area is related party transaction. Do you know who is related party? In a bank, subsidiary company of a bank is a related party. That means most of the banks, you know, these banks have buildings, and the building is owned by another company. 100% of that company is owned by the bank. I know even the HNB Tower, Ceylon Tower, those are not the banks. If you look at their balance sheet, they are not listed in that. Building belongs to Ceylon Development Company, and bank pays rent to that particular company. This is to actually avoid paying additional taxes. So those subsidiaries, now if you take Sampath Bank, there is a Siyata Finance. They are engaged in similar activity but finance activity. It's 100% subsidiary of Sampath Bank. Now if this Siyata Finance want money, bank cannot give because it's a related party. And if that related party fails, 100% is owned by it, so the risk will belongs to the bank. Similarly, they say your directors, board of directors, and the key management personnel and their immediate family are related parties. So any transaction with them need to be according to the central bank rules what they are given. Now, for instance, if I want to borrow from, if I am an employee, they might even give 75% of wholesale value of my property as my housing loan. But if a director wants that facility, related party, central bank has restricted to 60% of the wholesale. Because there's a saying, so I will ask this from you, what is the easiest way to rob a bank? We have never thought of it. Some people in central bank, or they think best way to rob a bank is to become a director of the bank. That's why this corporate governance has come. Because directors have key management person as influence. We call it an ownership risk. If I ask for a facility, that credit officer will go through all my documents. If a director asks, next 2 hours, you have already put the money into the account. That influence is creating a risk to the bank. So related party transactions are monitored and reported to central bank, and also should be recorded in your annual report as a disclosure. So that is another corporate governance rule to avoid the ownership risk. So with that, I think we have concluded our syllabus, all in all, and have you read the past papers? The subject matter is, though it is vast, it's limited to these risk types. So it's not a, since you are not practicing, you find it sometimes difficult because it's not your day-to-day banking. But I think nowadays, all employees of the banks are risk managers. Because in whatever area you work, there's some kind of risk involved. And without knowledge, you are managing it. Now what we have put is, we have put that on paper. And so theoretically you can study and you're practically doing it rather. Because first line of defense is all the staff who are doing risk. So we'll see whether we can get another day like this. Next week I'm on leave. So that is, I don't have a lecture. And the 20th and 27th is my final classes. 20th we will, if you are a little ready with the assignment, we can go through it once more. And then finally we'll do a past papers. But you need to read about questions and you can chat with me and ask questions, then only my thoughts will provoke, otherwise online teaching is not very easy on a subject like this. Especially you need to interact and get things faster. Especially a new line of subject, need to have personal contact to understand. How are you doing so far with those online classes? But I find about 30 or 40 people maximum participating in online. I think recordings are being checked subsequently. So it is same. Fortunately, those facilities are there. The previous sessions we never had this problem. So another new challenge for me, another new risk management for me. So wish you all the best. Thank you.